Christophe. It's great to see you. Thank you so much for being with us.
Hello, Maggie. It's my pleasure. Thank you for inviting me on the Real Vision. Always a pleasure.
It's wonderful to have you back again. And I think at a fantastic time because it's been such a difficult, first 5 months of 2022. We've seen a lot of volatility. We've seen very big moves across asset classes, a lot of things moving down in tandem together. So let's start off and kind of give me your macro framework about sort of where we stand right now when it comes to global growth and inflation.
So maybe, Maggie, to start with, maybe we could very quickly go why the pendulum swing has been so wild in 2022. Because in fact, in 2021, I guess that the markets believed the narrative of the Fed and of the developed economy central banks. Inflation will be transitory. Don't worry, we're going to be patient. There is absolutely no worries to have. It's only supply driven. Therefore, when the supply chain disruptions ease, when we're going to have the base effect that will kick in 2022, like by magic, inflation will mean revert back to our target. So we won't need to be too aggressive. The problem is, I think that there were two misjudgments. The first one was something that they couldn't preempt. It's the zero tolerance policy from China. And the second one being the invasion of Ukraine by Russia, which in fact made those supply chain and higher commodity prices lasting much longer than expected and offsetting the positive base effect that we were supposed to have from March onwards. The second one, I think it's a bit typical of the central bankism regime we had for 10 years. It's QE is not inflationary. QE will inflate financial assets, but will not end up fueling the demand inflation. So we're going to have an end result very similar to post GFC. There is one big difference. Post GFC was only easing accommodation, monetary accommodation, first of all. And secondly, post GFC, the housing market got decimated. So the net worth of the US household took, in fact, 5 years to recover. In 2020, we had something we never seen before, which is fiscal and monetary support. Direct checks, 3 fiscal packages. So the housing market took 2 months to recover. The US household net worth took 3 months. And now the US household net worth is 30 trillion higher than pre-GFC, while the housing market is printing new all-time high. So the private balance sheet issue we had post-GFC, we never had it post-COVID. So therefore, with all that money, that net wealth, that's feeling that everything was fine, you had also the demand side on the inflationary pressures. And I think they didn't see that coming, in fact.
They didn't. You rightly point out, they'd have to have a crystal ball to have seen first we've ever seen pandemic that resulted in such swift action. And as you say, this, war again, bringing us back to, the 1930s in the middle of Europe. I mean, these are the kind of black swan exogenous shocks people always worry about. Question about that net wealth. It's so interesting you say that because I literally just saw a headline, and this is very much, I think, a frame of mind if you're sitting here in the US that just said not most, but a majority of US households making under a certain amount, majority of Americans can't withstand a surprise $1,000 charge, say $1,000 charge for healthcare. So when everyone talks about this wealth effect and net effect, it doesn't feel like that for Americans. So how do you square that? Because most people are living paycheck to paycheck in the States. And, certainly you can understand why it doesn't feel like there's this enormous buildup of the $1 trillion of wealth that you talk about. So where is that wealth? Where is it sitting? Who's got it?
It's something I spend months talking about in my with my clients, because the Fed is talking about the excess saving, the net wealth of the U.S. household to justify the fact that an aggressive tightening will be offset. There is a buffer. There is a lot of money on the side. But the research you mentioned, which was, I think, a bank rate research, is showing that 60% of the American can't face a $1,000 surprise expense. So this is not, there is no excess saving. Excess savings are not equally distributed across all the income buckets. So let's say the top 10 got massively richer, in my opinion, in a regime where energy prices, food prices, rents are skyrocketing. Those people are suffering. And we saw with COVID that, what is the excess saving? Is it 1 month on the side? No, we know that it's excess saving is much more than that. And we had a cash flow disruption with COVID. And I think a majority of the US households are still in a very, I would say, difficult situation. Why revolving credit has exploded since November? This is not a coincidence. Why even the full amount of savings has melted since over the last 4 months. So when you look at savings going down, revolving credit exploding, it's not a sign for me of a widespread wealth across all the income buckets.
So it's really the worst of everything, because you've got enough excess savings in a small amount to create the conditions for an inflationary environment, but those higher prices hit the majority of the people who are not holding that excess wealth.
And exactly, and the people who've got the highest propension to consume as well. This is, the one who are giving the momentum to the U.S. consumption. So it's not the top one who's going to save the U.S. economy in terms of level of spending. It's those middle classes.
So, I mean, we just heard Janet Yellen become the last official to sort of give her mea culpa and say, well, we got it wrong. We should have been. It wasn't transitory. It developed in a way that we did not anticipate. Do you sense that, at least for the U.S., and then we'll broaden out to the globe, of course, but the U.S. is the main driver, at least from a consumption point of view, U.S. consumers. Are we looking at a stagflationary environment here, where inflation remains high, but because of the impact on the vast majority who live paycheck to paycheck, it's going to hurt growth? Do you think it's outright recession? What does the outlook look like?
I think that. First of all, I will make a difference between Europe, for example, and the US. I think that the macro outlook for Europe is extremely gloomy, and I can't see how Europe will escape a recession. And I think anyway that Q1 was already sending very important red flags. The start of Q2 is not very promising, and inflation is just can't be controlled because of the high energy dependence of the Union. On top of that, I'm massively convinced that Vladimir Putin has all the interest to make the war lasting as long as possible, to generate economic, social, human pain to the Western Front, and to regain leverage when everybody has got economy suffering some facing big headwinds. De facto, you've got some leverage back. In the US, I think the US economy is, despite little canaries that I talked earlier on, and like the revolving credit and the melting savings, I think the US economy is still showing some resilience. But in my opinion, it's very temporary, and I think that the best case scenario is is a stagflation, but the risk is a very, very aggressive Fed that doesn't see, in fact, inflation mean reverting quickly enough, and aware that you can't act on the supply side inflationary pressures, but you can engineer demand destruction, which means it's going to be the same who's going to pay the toll, and also trying to cool down the housing market.
Yeah, so you fall into the camp that the Fed will hike until they break something intentionally.
I think it's a part of the plan.
And what do you think that they're looking at now? So is it prices? Are they worried about the employment picture and wage inflation, which has been absent for so long? What do you think they're tracking, and what should we be looking at?
I think that they are tracking the financial conditions because, in their opinion, it's a way to put some pressures on the economy, on the asset class, and therefore on the what they think is a global net worth of the U.S. household. I think that they are looking at inflation first, but I find Mester very interesting because she clearly said, I don't care about the year-on-year rate. I need to see monthly stable reversing prints, which will tell me that slowly but surely inflation is back under control. So those technical, reversal are, I think, irrelevant. And we're going to have likely a plus 0.7 print next week for the CPI in May, after a plus 0.3 in April. I don't think that Mester will be very happy with it.
Do you believe them when they say something more aggressive than half a percentage point is on the table? Do you think that they will be forced to do something more aggressive, or how are they going to handle it? Because there's a sense they want to front load it.
I thought that 75 was on the table about a month and a half ago. I think they will go more by cliffs of 50. So in my opinion, for example, Powell at the May FOMC putting on the table that they're going to be 250 and then it's going to be data dependent. I think it's still the case, but I'm not sure that Powell is the one to listen to at the moment. I think that the two leaders you need to listen to are Chris Waller and Bullard. And in my opinion, Waller was crystal clear yesterday. It's several 50s, several is more than two.
So they're embarking on this. Two questions. They're embarking on this aggressive tightening. They have no control over the supply chain. So I understand their desire is to bring inflation down, but is it within their power to do that?
A big part of it, no. This is the.
They're going to kill the economy in order to tame something that they actually don't control anyway.
In fact, and this is the reason why they didn't start. I think part of the problem. They didn't start early enough. It's because they put on the table the fact that we can't control a big part of the inflation because it's supply driven. The issue now, you've got the demand side, and they're going to try to tackle that. At least cool down the housing market, and generate some controlled demolition, hoping that control will remain controlled.
And should we be thinking about asset class different than the real economy? Because in a perfect world, they'd like to pull down assets, right? Pull down the stock market wealth effect, perhaps cool down housing without killing the economy and creating, that cycle of layoffs and downsizing and defaults and small business failures.
And this is why it's a bit toxic, Maggie. They always talk about how healthy the private balance sheet is, household and corporate. So they're not scared about defaults for now. They think that savings will be a buffer. When you look at what is the Powell is talking about when he talks about the job market, he's talking about the unemployed job openings ratio. We are at 190. He said that I would like to see it at 1. So that strength of the job market is for now a green light to be more aggressive. The issue is we know that the unemployment rate is a lagging indicator. And usually when you print the law, it's just before the recession. The ADP last month showed that the small and medium-sized business is struggling. The Challenger job cuts was the first increase last month since January 2021. So I think that there are little signs, but the problem is the job market is very slow to react to start with, and then you realize when it's too late. I think that the message from the earnings season was essential in my opinion. Like anchors of the U.S. economy, like Walmart, just raising a big red flag, overcapacities, margin compression, U.S. household just trimming down discretionary purchase to really allocate the little disposable income, still disposable, to the basic needs. I think Amazon talking about overstaffing, Cisco saying that they're going to have to slow down the hiring process. When those names are starting to say, wait, there are some problems, I think you need to be a bit worried.
So against that environment, we've seen, the May has been really up and down for U.S. equities as people go back and forth, the camp that believes the Fed is going to go until they break something, and those who think they're never going to be able to hike as much as they say. Maybe we're in this kind of compressed cycle. You're going to start to see the weakness. You're already seeing it feed through in things like ISM and, some of those more leading indicators. And so there's this like push and pull. Would you be buying dips here? Do you think that most of the bad news is priced into U.S. equities, or are you in the camp that this is a pause and we've got further downside and pain to go in U.S. equity markets?
In the U.S. equity and more broadly speaking about equity in the developed world, I think it's a pause in a larger correction for two reasons. The first sell-off has been driven by multiples compression and by the derating that you could expect when the Fed is starting the tightening cycle. And I think the second part will be the earnings revision. I think that the forward earnings are still too high, so you need to price that to have it more in line with a more tricky growth outlook. Secondly, to buy the dip, the buy the dip relies on one specific thing, which is the Fed will provide you a bailout. So you need to know exactly where the Fed is about to pivot. I don't think that the pivot is nowhere near to pivot because they can't. They will never pivot with the inflation above 5%. If they pivot now, I think it's the worst news ever for US equities anyway, because it will mean we just throw the towel on inflation, loss of credibility, and it means a bear steepening of the curve, and then you have to be worried. If you know that, what did we know for 10 years? The put of the Fed is roughly 10% out of the money. So if you know that you're going to have your stop at 10%, you're going to front run the Fed and you're going to start buying a -8. But if I know that my competitor is going to buy a -8, I'm going to buy a -6 because I want to front run him. Right now, I don't think there is a sustainable dip to buy because there is no put of the Fed, or at least there is a put, but not here.
Yeah, we don't know where it is. There doesn't seem to be any consensus when I talk to people. Do you hear people kind of roughly putting a floor somewhere in where they think a Fed put is? For a while, people thought there was none, but do you get a sense there's consensus forming on that question?
I was making some calculation. I think that to go back to some financial conditions that will be more in line with the Fed target, you need to go to 100, and I think that will put the S&P around 3,400. So let's say 12 to 14% lower.
Wow, that's it for people who have felt the pain on the way down. That's still a significant drop.
But in the mind of the Fed, and bear in mind, I'm not trying to criticize the Fed because it's very easy, a posteriori to say it was so obvious. I don't know anyone who envisaged inflation to be at 8.5%. Nobody. So that's the first thing. And they've been late to tighten, but I think that there was a trauma of the human shock of COVID, which impacted their decision-making process. And I think that for Powell, there was a trauma 2018. And so I guess that human plus lessons of the past made them to be patient, and they wanted to target the US job market first. So
it's worth remembering that most of what we worried about previously was deflation, disinflation. That's what are we all headed to Japan? I mean, that was the predominant conversation before this.
The problem is, I started in the financial markets in 1992. Did I experience a high inflation regime? Not really. Did any of our central bankers experience high inflation regime? No. What we've been talking about for the last 20 years, as you say, Japanification, deflationary forces. When we had some tightening cycle of the Fed, it was not because inflation was tangible. It was in case. So central banks were fighting a ghost. The problem is the ghost has become visible. They were not ready for that. And especially after COVID, when the risk was, do you remember the comments after COVID was the biggest growth and deflationary shock of ever. You understand that?
And it was, but we had no idea they'd get a vaccine in
rather quickly.
That would front run all of the stimulus that was put in place. That stimulus was put in place with a much longer runway, and we flipped on that vaccine, which was amazing feat of human innovation, absolutely. But that timing didn't match up with all the stimulus that continued to hit even after populations were getting vaccinated. Exactly. Although it's been uneven, we always have to say that with the vaccines.
No, exactly. And I think as well that with the vaccine, I think that everybody thought, and me included at the beginning as well, that, we will restart a smooth journey of the economy, everything will reopen, the supply chain will restart like it was before. But the problem is you had a reopening of an economy, but the logistic didn't follow up. So
right, the demand started, but the supply chain didn't.
Exactly, yeah.
Again, sort of the worst of all outcomes. You mentioned 2018, and I think you're referring to that liquidity, the markets having a bout of liquidity issues that the Fed then and problems in the repo market or the money markets, and the Fed had to then intervene. We're just beginning. Quantitative tightening starts today, the beginning of running off that balance sheet. Are you concerned about the market's ability, the global financial mechanisms' ability to deal with that?
I think that Powell didn't necessarily learn the lessons of Q4 2018 when he was trying to assess where neutral rate is. And I don't think that anybody knows where it is anyway. So they're guessing. But the repo imbalances and the funding market chaos of September 2019, I think they pointed out, and I think they're going to be ready to quickly answer and to avoid another funding chaotic moment.
Well, that's encouraging. Do you worry about now we have interest rates going up, we have quantitative tightening, rolling off that support on the balance sheet, and we have a different fiscal environment where we're now again talking about contraction and discipline. So now what fed it, all three working in concert, all three are now being reversed at the same time. Is it too much?
I was looking at a graph where I put the what I call the average shadow rates, so the monetary policy gauge of the 8 main central banks. The Chinese GDP and the Chinese credit stimulus and the G4 credit stimulus. It's very rare that you have a Chinese economy struggling, coupled with DM central banks tightening, coupled with DM fiscal cliff, coupled with China not ready to push on the accelerator. The last time it happened, it was in Q4 2018, which was the only one time over the last 10 years. And we know how it ended up. It ended up by Powell forced to pivot early June 2019. The problem is inflation was below 2%.
Right. So this time around, are you worried about similar situations, but the Fed unable to come to the rescue?
I think that you're going to need to have two scenarios. You're going to have either inflation quickly reverting to something acceptable for the Fed. What is acceptable? I would say a core PC below 3%, or a proper recession where they just, in fact, have to stop to address the economic pain. But if inflation is still elevated, they're not going to be able to bring the support.
And does that scenario seem most likely to you as opposed to inflation reverting?
I think they're going to do whatever it takes to reduce the momentum of demand, to be sure that at least on their part they will be able to impact inflation.
We've been talking a lot about the U.S. market, but let's broaden it out now. And it seems like an incredibly perilous time for so many countries and areas of the world. And I know that you've been, in your research notes, kind of looking at some of the threats that the world is facing. And one of the paramount ones that we've been talking about a lot here on Real Vision is rising food prices. Are we facing the sort of doomsday scenarios of widespread famine and social unrest? Does that look like a real probability to you? Are there any tools that policymakers have to try to address these rising food prices?
Again, I always refrain from going into the fear mongering dynamic, but the fact is, creating social instability, starvation, or whatever you want, is a way to regain leverage for Russia. So what it means, there is scarcity of food. There is two big producers of crops who are out of the picture. You can see with India has to make a choice. So because national safety and national security, I need to ban my export of wheat. Indonesia went there and came back, but with palm oil. And I think that the danger is, a more fractured world where you need to think about your citizens first. Mm-hmm. Why China is always very careful about food prices? It comes from Karl Marx. Karl Marx always said that Louis XVI would have kept his head if he acknowledged the starvation of his population. So I think that we saw it in 2011. Food prices led to the Arab Spring. The FAO food index is 30% higher.
We have a chart that we'll put up for this, and it's I know it's the chart. I think you called it the horror chart, didn't you?
The horror chart was another one, but the food prices is definitely the
That's
horror.
That's also scary.
Chart.
Yeah. Okay. Well,
exactly.
we'll segue right to the horror since we're in this sort of theme of conversation. We'll get to that in a second, but that is really frightening that we are so much higher than we were when we saw that unrest spread around the world. And this sounds like a geopolitical conversation. This is an enormous economic risk. So how do you face that as an investor? I know some are trying to figure out whether they can. They should have exposure to food commodities. That's one way. But what are, what kind of risks or knock-on risks does something like that create?
First of all, I think that in terms of logistic, in terms of, how do we sort out the issue, it's very complicated and you can't do it on a couple of months. We are going to have the Russian and the Ukrainian crop, in fact, almost at zero, or not accessible to most of the developed economies and emerging economies. So I think that there is a social risk, there is a political risk, there is a risk of populism, because this is just the obvious byproduct. I'm personally long of most of the agro commodities in my personal portfolio, because I think that it will be sorted out only if we have a peaceful end to the conflict between Russia and Ukraine. And at the moment, if I'm right on my, the way I look at what Putin is likely trying to achieve, I can't see that happening.
The thing about commodities is that they can swing quickly, can't they? So how are you just outright long these commodities, or do you have protections in place? Because a peaceful solution is one scenario, a regime change is another, and you don't know what you get with that, whether it's worse or better. But that would kind of create the situation where you could see some sort of resolution that is almost impossible to handicap. And yet, if that were to happen, you could see really rapid moves in these commodities. So especially for people who may not be that experienced in them, how do you approach this? Like, how are you protecting those positions? Or are you just long because you think it'll take so long to resolve?
No, in fact, I build up some upside structure where through call spreads, to be sure, in fact, that I know exactly how much I invest, because I'm well aware of. Just look at the price action of wheat since February. It has been just like, if you have the outright position, I think it's extremely difficult to manage the volatility of the P&L of your performance. So I do everything through upside structures, neutral vol, to be sure that I can sleep at night with my portfolio. Anyway, with the allocation dedicated to the agricultural commodities.
Yeah, thank you for that, Christophe. It's really important, I think, to underscore that we are very conscious of risk management and size of risk these days because of the volatility. So important to put that out there, because we get a lot of questions about food. So as we're looking through this, I just want to kind of get back to Europe for a second. Is Europe uninvestable right now, given the growth outlook, what they're dealing with energy and inflation?
I came to the conclusion. I shifted from a medium-term, long-term investor, which was essentially matching as well the research, to, I think you're more in sniper, tactical, short-term trading, pragmatic, and I think that I always love what Harley Bassman is saying. Successful trading is not about ideas; it's about sizing and timing. And at the moment, I don't think that you can afford big sizing and you're not sure about the timing. So therefore, you have to shift your, in my opinion, so that's what I did, from set and forget investing view to, what, I can change my mind, not my mind, but I can shift my portfolio quite aggressively and quite quickly.
Do you have any exposure to anything in Europe right now?
So I'm gonna renegade my origins, but if there is a part of the world where I don't want to be invested, is Europe.
Yeah, right now, because of
I
all the
really think that
headwinds.
you've got the geographical proximity, you've got the geopolitical risk, you've got the energy dependence, you've got the macro environment is not sustainable, and when you look at the earnings, they've not been revised aggressively enough. So I don't think that you want to be long of euro. I don't think you want to be long of European equities.
Yeah, there have been a lot of questions and head scratching about the direction of the euro. People seem unsure. The ECB likely to raise rates. I don't know what your outlook is on what you're expecting from the ECB, but I've heard a lot of confusion on what impact that will have on the euro. People unsure whether it would weaken it or strengthen it.
So I had a discussion with an investor yesterday, and he was telling me if the ECB hikes very aggressively 100 bips over the next 4 months, the euro has to strengthen. I've got reservations about that because I don't think that the European economy will manage 100 bips in 4 months, considering the current macro headwinds. So the worst is the ECB needs a stronger euro because higher food prices, higher energy prices, and weakening euro is the lethal mix and the worst case scenario you can expect as a central bank. So it's Altman this morning say we need a stronger euro. Yeah, but I don't think the market will let them to have a stronger euro because I think for me the euro at the moment is lose-lose. Either they hike to control inflation, and the economy is already substantially slowing down, so you have to price a recession, or they're slow, and you have to reprice the already damaged credibility of the ECB.
Not a great situation. Do you see the euro going to parity with the dollar?
Yes, I think that I think this is most likely. I think the euro will only appreciate against the dollar when the Fed has done the job, in fact. So I think the euro dollar will be driven more by the dollar than by the euro.
And the dollar has been strong. Any reason to think that won't continue? And are there concerns around that? You know, that there's that saying, the dollar wrecking ball.
I think there is some kind of, safe haven status, thinking if there is one economy who has more chance to remain resilient despite an aggressive Fed is certainly the US, the dollar, the US. It's the energy independence, so which as well make thinking people that the US is well positioned. But I think the real problem is if you sell the dollar, what are you buying? This is always the problem, it's in FX. If you sell something, you need to buy something. Can you buy the euro? No. Can you buy the sterling? Not really. You want to buy the yen? Not now. Aussie, it's a risk on proxy and a China proxy. Canada, yes, but it's almost the same trade, US and
Right.
CAD.
Swiss franc,
Kiwi,
but
Kiwi, it's a too small economy, I guess. So I think the problem is, do you want to be long of EMFX today? I think it's too early. So I think the problem is more like there is no alternative.
a different kind of there is no alternative than the one we were used to.
Sometimes it's like
US tech stocks.
It's like, and if you long of yen at the end of the day, it's a bit scary because what you're playing, it's a global recession.
And that's the thing, isn't it? That's which is not good for anyone.
No, and I guess that it's some kind of optimism. Nobody wants to be long of yen as well because this is the proper Armageddon scenario. And
we've seen the dramatic moves in the yen. Charts that we've never seen. Do you think that that Japan can stick with its yield control policy? Are they going to be forced to abandon that?
I think that if the BOJ wants to keep on to keep the yield curve control, if Kuroda wants to remain like he is, so Peter Pan, I've got convictions, and I'm gonna do whatever I have to do to be sure that we don't leave the twilight zone of the monetary policy. They're going to be challenged if inflation breaks 3%. So I don't think it's impossible, but I think that for now he has shown that his determination to remain the outlier. He went to turbocharge the yen as well. It's that big unwind of the carry trade of Japanese investors, the long treasuries FX hedge. They just realized that carry trade doesn't mean safe trade. So
which when safe haven trades like that break the way this has, what are the implications of that? I mean, do we even know?
This has been the issue until mid-May. There was almost nowhere to hide, except the dollar, in fact. And this is why I think that the dollar got bounce, it's not only because of the Fed, communication, because all the central banks in Fine have been hawkish. It's because you need to find a place. Why we had the acceleration, in the equity sell-off 2 weeks ago? Because Walmart was supposed to be a safe haven. And if Walmart is not an anchor, it means that all your portfolio where staples is your defensive, allocation is collapsing.
Are we still in that? There's no place to hide. Everything's going down together. Are we still in that moment?
But today is a bit different. But I think that we regain some, safe haven luster for the treasuries. And I think that what is the biggest market risk is when the correlation between US equity and US rates is a shifting negative, when everything is just selling off. So as long as you've got that positive correlation, I think the moves will be a bit more controlled. It's when everything is starting to sell off that you have to be worried. So in fact, we need to watch carefully the real yields of the US. It's when it accelerates that, that the correlation tends to shift.
Yeah, and this has been the case, hasn't it? Like it does seem that the bond market is driving the action. But we've seen huge moves there. We've had hedge funds get killed for being on the wrong side of that trade. Is there more clarity now around bonds? Are bonds a place to go? Where would you go in terms of duration?
The problem is it's. I think one of the big driver of the sell-off of the fixed income was as well the fact that German yield were supposed to remain negative until the end of the humanity. So when suddenly you take off that pillar, which all the portfolios have been built up around JGBs, and Germany will remain at zero forever. So therefore, you have the free ride is to buy treasuries because you pick up the carry. You buy large tech, you buy credit because everything looks attractive compared to 10 years German at minus 50. When it started to move, that's when the big sell-off started. I think we're going to be range bound on the US yield for the time being, and so I would say that around 325 on 10 years, I think it's the right place to re-enter. But I don't think we're going to collapse for now because you still have the Damocles sword of the Fed tightening.
There's been a lot of discussion about China and the state of their economy. We know, you mentioned, we had no way of anticipating their zero COVID policy, which is still going on, still roiling supply chains. We saw all the crowds run out of Shanghai. Let's see if they're still out by the time this airs, because from day to day, we don't know. But would you expect to see the Chinese economy start to grow and recover now, or is there something more structural going on there that COVID has masked? Some sort of weakness in the Chinese economy that's we need to worry about more than something temporary like COVID.
But the problem is, first of all, we will never know the exact state of the Chinese economy, and we don't know the exact state of the health state of affairs. I think that the economy is contracted in Q2. That we are running, if we look at the official numbers, more closer to 3.5% year on year for 2022, rather than the 5.5% that the authorities wanted to achieve. I think there are, first of all, there are structural issues. The Chinese economy, without the property boost, without the infrastructure boost, is not the same economy, and shifting the model of the Chinese growth from what I call the QC, which is a quantitative construction, but from QC to the domestic demand, it takes time. And on top of that, you can't achieve if you put 20% of your GDP at home. So there is a structural issue. I think the authorities don't want to go back to the excesses of the past. And one reason being, they were giving free money to the West, and they really don't want to do it neither. So I think that it's a refocus on the domestic that's going to take years.
And this is going to be impacted by this regionalization you're talking about as well, the spheres of influence.
If I have a very strong conviction, it's I think globalization has been undermined and will remain so. I think you have to think about more, local blocks. I mean, at the end of the day, Europe, if you're a European producer or manufacturer, you're thinking, where should I get my goods now? What should be my supply chain? Should I rely on Asia or should I rely on local producer? And I think you're going to shift from a sea freight to a more like a road and rail freight, because it's going to be more like little blocks with little communication between them. But China, I think in the short term, she has got the 20th Party Congress in October, and there are more and more, little signs that is criticized about the COVID policy, is criticized about the poor vaccine, is globally criticized about the way he has aggressively destroyed the economy in 2021. So I know that he made sure that he's going to be elected for life, but I think that he will try to come to the in front of the Politburo in October with a bride slightly better looking than currently. So I will not be surprised if he does a couple of months of a strong impulse, just to be sure that he's got some momentum going into October.
It's interesting. You as we sort of look out and try to navigate the rest of this year, you make a very interesting point in one of your notes that you have Russia weaponizing energy, the US weaponizing the dollar, China weaponizing COVID with its lockdowns, and food exporters sort of forced to weaponize their output in order to protect themselves. That is a very difficult environment to invest in. Against the backdrop of those risks, what looks attractive to you? How are you navigating this?
As I told you before, I think it's very challenging because I'm not sure where the value is, and not the value. I have ideas on medium-term values, long-term values, but it's if you go to the Maldives, you're feeling safer with the Emirates rather than different airlines. So I've got an idea of the destination, but the journey is going to be very tricky. So I told you I'm very nimble. I never been, my allocation in cash has never been so high. It's just because the volatility on a daily basis is I think your risk reward is not interesting, and I really think about risk reward. So it's or you need to put your stops very very close to where your entering level, which means that you can be out very quickly. So I don't think that this is a healthy environment to be very heavily allocated. And then I think that this weaponization will last, because it's any war has led to a transition period where you've got antagonism, start of crisis, and it's very unstable. And in fact, we had a war against a virus, and now we have a war, but a real one, a battlefield one. And I think that those moments usually leads to more difficult and volatile moment where you need to be humble.
Is there a risk that you think investors are not taking seriously enough? Are there spots of complacency that you worry about?
A little bit. It's where I see it, Maggie. It's if I tell you what is the biggest question that I got at the moment, So, but a few months ago, it was, where do you think inflation will peak or when? Where do you think 10 years US will stop? Now it's, when do you think the Fed will pivot? And this is 10 years of brain wiring. At one stage, because we can't handle the pain, the Fed has to save us. I don't think we are there. And this is, for me, the biggest risk.
We haven't adjusted our expectations to this new regime.
It's 12 years of central bankism is a long period.
And we don't know what it looks like on the other side of that, right? Because is there a spot in history that you go back to when you're looking at this? Because we know Volcker and the inflation fighting Fed of the 70s is often talked about, but many people don't think that matches up. That those historical comparisons don't seem to work for them, and it's very hard to think about that when you layer on technology and everything else that we're living in this age. It doesn't seem quite right. Where do you come down on this? Do we have any point of reference we can look to?
No, I think it's a very, very specific environment where you have a pandemic, which is now an endemic, but it's still something we didn't experience over the few last decades. You have China shifting. You have Russia trying to destabilize the Western Front. You have somewhere China and Russia are getting close again. This is very particular setup, and so it's I spent quite a lot of time trying to find an analogy and trying to finding a roadmap. And sometimes this is a mistake because we desperately try to find the end result by looking at the past. I think this one is a bit more, I would say, adventurous.
Yeah. And throw on top of that the fact that we are unwinding what has been one of the greatest experiments. I mean, there was no such thing as quantitative easing. This is, or maybe small pockets of something that looked like that, but on the scale that it was put in place after 2008. And the interconnectedness of global markets. It's very interesting because you're not the only one to raise the concern about regionalization and sort of, I like that you say globalization is paused. Some people think it's dead. And yet the financial system, the global financial system is very interconnected. Can we separate, can we regionalize on a geopolitical basis while the global financial system is so integrated?
Yeah, it's somewhere. I think it's possible. It's possible. I tend to think that the financial market have been so disconnected of the macroeconomy reality for longer. I guess that at the end, money is going where it needs to go to generate profits. So I will think that this will prevail.
We haven't talked about emerging markets, and we should probably sort of come full circle in this discussion. So many of the risks you talk about, we talked about the major players and what they're weaponizing. With the emerging markets in some ways are going to be having to navigate this and feel the effects of this without really participating. How will they fare? Is it going to be very uneven in terms of who thrives and who doesn't in this period of transition that we're in?
Yes, I think you use exactly the word I would use. It's I don't think we can look at the emerging market as as a block anymore. I think and this is nothing really. It's not anything aggressive or whatever. I think you need to look at what are the strong balance sheet and the weak balance sheet. And by that, I mean, you want to be positioned for emerging markets who are exporting commodities. You want to be allocated in emerging market who's got cheap or affordable workforce. You don't want to be in countries who are heavily dependent on energy and food export. So I would rather, one of my biggest positions at the beginning of the year was Brazil, for example, because I think that Brazil has got that workforce plus commodities available. I think that you don't want to be invested in Turkey because it is exactly the example of the weak balance sheet for the EM world in the current environment, where the Fed is tightening, and when your inflation is at 70%, because you're highly dependent of the energy and the food export.
We talked about food continuing to go higher. Do you think energy has peaked, or do you expect energy to continue to go higher? There's some pretty aggressive targets on crude oil out there.
Let's assume that we don't have a ceasefire tomorrow, because this is a game changer, obviously. I think that we're going to go higher on the crude. I think the pain trade is 150 for many reasons. The geopolitical premium is not, is offsetting to some extent what the Fed is trying to do, which is destroying demand. And usually it starts with petrol. Petrol starts to roll initially. I think it keeps petrol very sticky. I think that the OPEC has no interest to play the game of the Western Front, because Saudi is very dependent of the agricultural commodities of Russia and Ukraine. And I'm sure that there is some agreement between Putin and bin Salman. Don't be careful with what you say if you want my grains. I think we had a decade long of underinvestment in the fossil fuel sector, and we're paying the price now. We have still a very tight market and supply-demand imbalances. So I think that the risk is to have a higher crude. I don't think that crude will collapse anytime soon.
And Europe, I say we're going to end on emerging markets, but I just want to get this one in here. We talked about the euro perhaps going to parity. We talked about German rates. Does the European Union stay together? I mean, if Putin's intent is to put as much suffering and damage and strain on the Western front, and we get into winter and those energy prices are biting, the European Union is very united right now. They just passed the sanctions. NATO is expanding. They seem in some ways more united than they were before. But we've seen in the past how difficult it is to conduct monetary policy for one varied region with all the differences they have. Do they get through this test as well?
I think it's going to be a very interesting test, because to a certain extent, not an amazing growth, but a growth momentum has enabled, a rather smooth journey for Europe over the past, at least pre-COVID. Draghi has done a lot of job to unify, Europe by compressing the peripheral spreads to a certain extent. It's just redistributing some over the area. Now it's going to be interesting, because we haven't seen the big deterioration of the growth outlook yet. It's only emerging at the moment. Someone told me that it's not an issue, because if energy prices are remaining very high, we will just leave the budget orthodoxy, and we will we'll increase the deficit. Yeah, but you don't have the ECB buying your debt. So if you do that, where you're going to have 10-year Italy, where you're going to have 10-year Spain, and
this is how it begins. If you loosen,
this is how it begins, exactly.
Yeah. And we saw the difficulty in the sovereign debt crisis.
Look at in 2011, it's all started. In fact, everything started in 2008 when Trichet hiked rates, because when you start to tighten, when inflation is high and growth is slowing down, who suffers? The poor, always, not the wealthy. And I think it's going to be a tough time for the union now, because what do you do if 10 years Italy goes to 5%?
And the problem, once that starts to happen, is you just get the natural investors who start to test how far it will go.
Always.
So So do you think it survives? Do you think the European Union survives? The euro survives?
I think they're going to try to survive, but at the same time, when I see that they declare a ban, or partial ban on Russian petrol, and Orban has got a green light, it's somewhere in the big union of Europe. There is still some fundamental issues, in my opinion.
Okay, that sounds like a wait and see. These are big questions, and they are kind of scary ones, to be honest with you, when we think about that's the reversal of what we've all become accustomed to. So it's, I think, right that we tread carefully.
Yeah, maybe it's when you take out the central banks out of the picture, you bring back price discovery. And we are not used to price discovery anymore.
No, we are not. I know. That's a nice way of putting it, Christophe. We are not used to that, but we certainly have the sense that that's something we're going to have to get used to, at least in the next few years. Christophe, amazing conversation. We covered an awful lot of ground. It's fantastic to have you back on. So appreciate all the insights.
No, thank you for your time. It was a pleasure, Maggie.
And you'll come back again soon.
Thank you. I will. Thank you very much.
Hey there, revolutionaries. To join a community sharing insights like the one you've just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.